will analyze financial stability in the context of the current crisis. And in addition to the banking dimension, we will explore the non-banking financial sector's contribution. So, first, as keynote speaker, Robert Ophèle, chair of the Autorité des marchés financiers, will share his views regarding financial stability, the perspective of the non-banking financial sector. We will then proceed with a roundtable at which we'll be joined by Luís Laginha de Sousa, member of the Board of Directors of Banco de Portugal, Luís Silva Morais, Associate Professor at FDUL, Faculty of Law, University of Lisbon, Neil Akers, Managing Director of Global Regulatory and Public Affairs, Moody's Corporation, Tanguy van de Werve from EFAMA, and the moderator, Rui Jorge, Director of the Strategic Analysis and Communication Office at the CMVM. Thank you.
Podemos tirar, acho que é esta. Ora, muito boa tarde a todos. Obrigado pela presença e sabemos que deixamos pouco tempo de almoço, portanto, as desculpas por terem que correr um pouco para chegar aqui a horas. Eu espero que Tanguy van de Werve e que o Neil Akers nos possam estar a ouvir. Passarei já para inglês, será a língua de trabalho da sessão. So we'll be talking about the financial stability in the next hour or so. Financial stability, but trying to focus a bit on the non-banking financial sector and how it relates to the banking sector, to the overall financial stability issues. When we talk about the non-banking financial sector, for many people, I believe it's not well understood exactly what it is in the first place. And then after that, and that may be explained why sometimes it is also difficult to explain or discuss the importance that it has for the financial stability in general. But that has maybe not changed in the last months, but definitely gained proeminence in the debate over financial stability issues. So this non-banking, just to have an idea, the non-banking financial sector is growing faster than the banking sector and is now as big as the banking sector in the European Union. So roughly speaking, we'll be talking about around 45 trillion euros. So for the Portuguese audience, that is 45 billion euros for both sectors, banking and non-banking, roughly. In the non-banking sector, we have the funds industry that we've talked a lot. We've talked about it a lot this morning. We have all the activities of securities lending, derivatives, and the post-trading activities and settlement activities on those assets. So one of the things that happened after the global financial crisis was this idea that maybe, or due to the fact that the banking sector was hampered, let's say, due to regulation and also due to the huge impact on its balance sheets, given the impacts of the crisis, the non-banking sector has been growing. In some sense, that's good. That diversifies risks in the system. So it's a good thing that we can have the risks more spread around the economy. On the other hand, it poses new risks that we have to face. So these entities, some of them engage in maturity lending, something very close to what banking entities do. And they face also, and so they face risks of liquidity. That's maybe the most well-known risk. And in the recent crisis and the COVID crisis has put this really in the front line. As we've had, and we'll talk about it later, we've had some episodes of liquidity pressures, both in the funds industry and in the money market funds industry. Then there's interconnectedness, both within the non-banking sector, but also between the banking sector and the non-banking sector. The example, more common, money market funds and the funding it provides, they provide to the banking sector. And then, of course, you have procyclicity, which is also really well known from the banking discussions, and that happens also within the non-banking financial system. And in the recent crisis, what we've noticed, or some of the issues that had to be dealt with, were margin calls on transactions or done with derivatives. So this is to give an idea that maybe we have more or less the same risks on one side or the other, but this non-banking is not that well known. And in the COVID crisis, it has become to the forefront of the discussion. So what are the maybe risks that affect all the financial system and also the non-banking? Risks of severe contraction in the economic activity, risks of high indebtedness. It grew after the global financial crisis significantly, and that with lower credit quality. We have the context of the lower for longer interest rates. That obviously is a challenge for the profitability of financial institutions. We have market liquidity issues. And finally, we have the risks of policy fragmentation, and we've talked about it also in the morning. So I won't take you longer. I will obviously thank, and I will come to that again, to our guests here on the stage, and both to our guests watching via Zoom. But before that, I would invite you to see this intervention by Robert Ophèle.
Good afternoon, ladies and gentlemen. Many thanks to the CMVM, and many thanks to you, Gabriela, for giving me the opportunity to share some thoughts with you on the threats posed by non-banks to financial stability. Development of non-bank financial intermediation has been very impressive after the great financial crisis. To a large extent, it has been a substitute to bank financing, which was somewhat restrained by the new Basel III regulation. Correspondingly, while there was a feeling that the robustness of the banking sector had been significantly enhanced by the new regulation, non-bank financial intermediation, once known as shadow banking, appeared more and more to be the weak, dangerous link of the financial sector. For a long time, it was a rather theoretical discussion. But COVID-19 real-life stress provided some hard facts to discuss. And while highlighting the global soundness of the sector, it also brought to light a number of targeted vulnerabilities. One could easily advocate that the non-bank financial sector's resilience has been demonstrated throughout the March-April episode. Market infrastructures have remained open, receiving with high levels of volatility record volumes of equity trades with, for example, a peak of 11 billion euro daily on Euronext Paris, almost triple the usual volume. Post-trade services performed their role despite sharp price movements which led to significant margin calls by CCPs. These calls were all honored, and clearing houses encountered no major difficulty, playing the role of shock absorbers. Open-ended investment funds sometimes faced large redemption requests, but suspensions were rare and they did not trigger any systemic spillover. Furthermore, Funds considered vulnerable in the stress simulations produced by the European Securities and Market Authority, the ESMA, and the European Systemic Risk Board, the ESRB, they did not face any of the problems feared. But naive optimism would be highly inappropriate. Some segments of the debt market just froze and resumed only after the decisive intervention from central banks. Some segments of the money market fund industry suffered from such high outflows that they were on the brink of being suspended. Suspension of money market funds, instruments which are perceived as cash equivalent, would have been a disaster with detrimental spillover effects throughout the whole financial sector. The crisis has indeed highlighted both the high level of interconnectedness of the fund industry with all other financial institutions and just how complex its supervision could be. Complex indeed, since we often have a management company licensed in one jurisdiction, but having registered its funds in other countries, the management delegated to other firms, and selling the funds worldwide, often as units of life insurance contracts. I do believe that the March-April episode is a free warning that should trigger a review of our regulatory framework and of our supervisory approach. In that perspective, let me share with you some preliminary proposals for the EU fund industry. First, there is a disastrous lack of official data in the fund industry to allow a close monitoring of the sector at the European level. Each national competent authority has its own set of data, but on top of suffering many gaps, especially on the fondholder side, these data are neither harmonized nor consolidated in the EU. Supervisors have too often had to rely on external commercial sources to conduct their analysis. COVID-19 made us improve our approach. We collected and shared a lot in crisis mode within ESMA's or IOSCO's networks. Thank you, Gabriela, for having been instrumental as chair of the Investment Management Standing Committee of ESMA in order to improve data and fact sharing at the EU level. But we should obviously dramatically improve and industrialize our data collection. Supervisors should be in a position to monitor almost in real time the evolutions of every category of fund, their liquidity positions, and the recourse to any liquidity management tools. Second, we should review the prudential framework and harmonize the regulation in order to have a fully fledged single rule book in Europe. For money market funds, liquidity ratios should be adapted to the crisis we have encountered, with possibly a two-tier system with a core requirement and on top of it a guidance that could be alleviated in time of crisis in order to play a counter-cyclical role. The scope of the prohibition of support to money market funds, which, by the way, does not exist in the US, should be clarified, if not reduced. More generally, directives with minimum harmonization should be replaced by regulations without national options. A comprehensive range of liquidity management tools, swing pricing, anti-dilution levies, redemption notices, gates, and side pockets, should be available in all jurisdictions, and we may want to go further and make these liquidity management tools not just available on an optional basis, but compulsory for some types of funds, with due mention, of course, in the prospectus. It is advisable to have a toolkit with all types of liquidity management tools to be able to adjust to every specific situation. The responsibility of every supervisor should be fine-tuned in order to avoid overlapping remits and loopholes. One could, in that respect, imagine to have a lead supervisor designated in the home country of the asset manager. His role would obviously be facilitated by the harmonization I've just mentioned. Finally, the role of central bank would also need to be clarified. It would be prudent to understand ex ante what could be expected from central bank in case of systemic financial crisis, and how access to central bank money could be organized for non-bank institutions, either indirectly through the banking system or, some cases, directly, as we have seen in the US. As you may realize, we have a heavy program on our agenda. Non-bank intermediation is at the core of any financial market union. And we still need to make considerable progress in order to achieve this in the EU. Thank you for your attention.
Thank you very much to Robert Ophèle for his intervention. Unfortunately, he could not join us in Lisbon or make it via Zoom. He did, however, make a significant contribution to the debate, mentioning, I would say, the main challenges that we face when we think about financial stability, looking at it from the side of non-banking financial institutions. I would probably try to start with Tanguy van der Werve, hoping that, Tanguy, I'm not sure if you're able to listen. Hi there in Brussels. Hello. Neil, are you also?
Yeah, very well. Great. Hello.
Okay, thank you. Were you able to hear the intervention of Robert Ophèle? You were? Okay, great. So, Tanguy, I'll start with you. So the funds industry has been really at the center of the policy worries and the policy actions in what comes to financial stability during the COVID crisis. ESRB, for instance, has issued, as you all know, recommendations very recently addressing namely worries about liquidity and leverage in the industry. So why is it? Could you explain us why was it that in this crisis the funds industry and the non-banking financial sector gained this proeminence, and also showed us about how you view the main risks going forward on that side?
Yes, thank you, Rui. Thank you very much also for the opportunity to take part in this panel. I think you mentioned it yourself, in your introductory remarks. I think the focus on the asset management industry probably predates, the March 2020 crisis. Some of those recommendations made by the ESRB, for example, were adopted, months ago. And if we look back at the FSB, I think it was all coming out of the FSB and the central banking community. I think they've had concerns about our industry for quite some time now. And I think the reason for that is, what you explained earlier, i.e. that, assets under management have increased substantially since the great financial crisis. In Europe, they have tripled since 2008. Also, I think there is a recognition that the banking sector is more resilient today than it was in 2008, and then naturally the focus then tends to be on other sectors of the financial ecosystem. Clearly, the banks have reduced their inventories, their capacity to provide a market in some papers, and therefore this has an impact on liquidity. You may also mention the interconnectedness with the banking sector, and Robert Ophèle also mentioned it at some point. And indeed, our funds, we buy paper issued by the banks. Our derivatives and repo counterparts are banks. Some of our asset managers have ownership links with banks. And sometimes, of course, we also have common asset exposures. Also, we are less regulated from a macro-prudential perspective than banks. And this is normal because we are very different than banks. And so the risks that we pose to the system are very different. Also, the ETF market, is a concentrated market. MMF, money market funds, are very important for monetary policy transmissions. And also, while the EU regulatory framework is very comprehensive, it may not be the case in other geographies. So for all those reasons, the focus has been, over the last few years, on the non-banking sector, including, indeed, our asset management or investment management industry, as we call it. Now, the big question to us is, all those fears I just mentioned, and those are, a run, for example, on open-end funds, or the liquidity in the bond ETF space evaporating all of a sudden, or fire sales following downgrades by Moody's or S&P, from investment grade to high yield, and then we have a fire sales of fallen angels. Now, if we look back, and I think Robert Ophèle did recognize this, if we look back in March 2020, actually, we did well, our sector. And we benefited from this existing, very robust regulatory framework that we have in the EU in terms of, detailed liquidity risk management rules, stress testing rules, some thresholds. So when we enter the crisis, or at least, this kind of high market volatility that we experienced in March 2020, the funds entered the crisis with a very strong liquidity positions. The outflows were very high, but all in all, it remained completely manageable. The bond funds, including high yield and emerging markets, were able to navigate these outflows. And yes, indeed, we have liquidity management tools, and those have been used. But that's the purpose of having those liquidity management tools. And I was happy to hear that Robert Ophèle is recommending that those be made available across the EU 28 or 27, I should say. And this is not yet the case everywhere. The bond ETF liquidity did not evaporate. If anything, the bond ETFs delivered incremental liquidity to the bond market and promoted price discovery. We didn't have any kind of asset sell-off, and fire sales. And money market, and again, Robert Ophèle mentioned it, none of those money markets were ever suspended. Yeah. And of course, he said, fine, some of them were about to be suspended because they would have reached the threshold. But yes, the reality is none of them did. So there have been very, very few suspensions, including in the bond market. There have been some, as we know, in the UK, in some of the Nordics. But this remains an exception. And frankly, it's a very tiny number of funds compared to the, I think, more than 30,000 UCITS that we have in the EU.
So tell me, allow me to make a sub-question if possible. So going forward, how do you see the major risks? One of the things that we're seeing is that despite the recent, the better conditions in markets and the inflows into the funds industry, liquidity positions do not seem to have been improving, and significantly, at least maybe not as in the UCITS industry, not as much as it would be probably expected. And how do you see this liquidity risk going forward, given that, as we've talked in the morning, we are probably facing a very tough time in the coming 12 months or 18 months in the economy?
Yeah, listen, I don't have a crystal ball. I think it's too early to jump to any kind of conclusions. We need, as Robert Ophèle mentioned, we need to collect further data to analyze what has been the real impact of the central bank's intervention on the liquidity in some markets. I mean, this is key. In the meantime, since March, in some member states, some new liquidity management tools have been introduced. So I think that we are probably in a better position today than we were back at the end of Feb, because we have the experience. We will need to stress test the portfolios using the most recent data. I think for us, so in terms of financial stability, there should be no complacency. We are not out of the woods yet, if you wish, that's for sure. But we see no reason for changing or bringing about major changes to the very robust framework that we have. I think the risk that we see, that it has nothing to do with financial stability, is a risk of knee-jerk reaction of some authorities in the EU adopting ill-suited bank-like macro-prudential rules, such as the use, for example, of mandatory liquidity buffers to our funds. We don't see this. We don't believe this would be effective. It could be, pro-cyclical, and clearly, there is no way any liquidity buffer would ever be sufficient in case, there is absolutely no more liquidity in the market. So to answer your question, I think that one should look at the different markets, especially, the money market, not the money market fund, but the money market and the bond market. What can we do to improve the liquidity in those markets? Let's look at the microstructure of those markets. What about, the fact that CPs, commercial paper, for example, is not eligible as high quality liquid assets for the LCR of banks? Could that be an option? What about the electronification of the bond market? A bit like we have for the equity and the currency market. So really looking at the market liquidity more than the fund liquidity, because again, the funds have passed the corona test successfully so far. So I would be more inclined to look at the underlying markets than the fund market.
Thank you, Tanguy. I'll come back to Lisbon now. Luís, Laginha, Sousa, thank you very much for accepting the invitation and joining us. So Luís, we've heard here that the banking sector has become much more resilient after the global financial crisis, and that's maybe why we're looking so much at the non-banking financial sector. So we very much like to hear your views on what weaknesses still persist in the banking sector, and how do you see this relating with the overall financial stability and naturally the relation with the non-banking financial sector?
Okay, first of all, I would like to say a word of thank you for CMVM for the invitation. It's really a pleasure to be here. Of course, also to my panel colleagues, those who are here, those who are outside Portugal but also present, of course, for all those attending. I mean, it was really interesting to see the topic of financial stability as a key topic to this round table. The topic of financial stability is something that is embedded in the mandate of central banks and, of course, in the Portuguese central bank. So it's a topic very close to our hearts. If you combine financial stability and capital markets, I think given the challenges that we have ahead, it's really a very powerful combination. So it was with a great pleasure to accept the challenge. Coming to your point about how prepared or how better prepared is the financial sector, and particularly looking at the Portuguese banking sector, which is the one that is mostly covered by the Portuguese central bank. As you've said, and I think it's important to highlight what supports this idea that the banking sector, it's much better prepared, much more resilient when it entered the pandemic compared to how it was when it had to deal with the global financial crisis. And I can highlight a few ideas, and basically they have been extensively covered in the Financial Stability Report, which is a report that is published twice a year by the Portuguese Central Bank. And the last edition of this Financial Stability Report had a strong focus on at least trying to provide a better understanding of how the financial sector, how the banking sector, but not just the banking sector, the other economic sectors, entered this pandemic. And in fact, there are a number of factors that were pointed that provide, I would say, a bigger comfort in terms of the resilience and how the financial sector is more prepared to deal with this situation. I mean, things like, if you look into capital ratio, they have increased substantially since the last financial crisis. We're talking about almost 8 percentage points compared to where it was back then. The total assets that are managed by the financial sector in comparison to GDP has shrunk substantially, which means that there has been a strong reduction of indebtedness, which of course allows here more cushion to deal with what comes ahead. The funding structure of the Portuguese banks also changed substantially, moving more into customer deposits, and this of course also provides an additional degree of resilience if there is eventually some turmoil in wholesale markets. If you go back to the previous financial crisis, this was a huge problem because the banks were financing themselves in international financial markets, and suddenly they were closed, so there was no access to financing. That is not the case nowadays. And so there has also been a lot of improvement in terms of efficiency, in terms of profitability, at least in the last 2 years prior to the pandemic. We were completely aligned in terms of average with what is common throughout Europe. Of course, we had a period before where we were still pretty much disaligned, so there is some legacy there. And I think this provides, I mean, I don't want to be, I don't pretend to cover all the topics and not to paint a too rosy picture, but it's important to have this in perspective. In fact, the banking sector and other economic sectors, including companies, including households, they entered this pandemic in a much better shape than when we entered the last global financial crisis. Now, in terms of the challenges that are still ahead, and what can be considered some main weaknesses. I can use an expression more, we should not be happy for others' misfortunes. But the truth is that we're not alone, and it's better not to be alone than to be alone dealing with the situation. And by this I mean that the challenges that the Portuguese banking sector is facing, they are not substantially different from the challenges that other banking sectors throughout Europe, mainly, which is the peers we tend to compare with, they are also facing. And so we're talking basically about profitability. I mean, there has been a huge decline in profitability, and this is something that is not sustainable over the long run. I mean, any business, and banking business is no different in that perspective. Has to make a profit in order to be viable. Of course, there is the capacity to hold sometimes long periods of low profitability, but you have to tackle this in the long run. There are items, probably they have already been mentioned here in the morning, things like cybersecurity. It's clearly a major threat, and to deal with this, there are investments that that have to be made to deal with cyber security. You have new entrants in the market. So, I mean, it hasn't been talked here, I think, a lot, but it's clearly a core topic, and probably we're talking this at lunch. If the pandemic didn't happen, probably the only thing that we would be talking, almost the only thing that we would be talking this year, would be about sustainability, climate change, how to tackle the risks associated to climate, to physical risks, to the energy transition. So this is also something that is a huge challenge, again, not just for Portuguese banks, but clearly also for Portuguese banks.
Mm-hmm. How would you? One of the things that we'll be talking just in a minute with Neil is this idea of having the rating agencies, well, in general, the credit quality going worsening, and then rating agencies, in some sense, following that deterioration of the economic conditions. So that was a big issue for the banking sector in the previous crisis. You already told us that the capital ratios are much higher, but how do you view this, the risks going forward 2021 related to this impact that we are still not sure how strong it will be, because the moratorium in all the policies, both from central banks and from the official sectors, have kind of delayed the impact, and hopefully they have made it softer, but still it will come at some point. How do you see this?
Well, this is clearly one of those topics in which if someone comes up with a crystal ball, it would really help. But trying to be as objective as possible, it's still not clear what the outcome of all the things we're going through will be. Clearly, I mean, if you combine all the information, one has to say that there is a more downside risk than an upside risk. And of course that will have its impact, but it's an impact that so far, and again, I think it's important not to insulate or isolate the Portuguese banks from the general picture of the European banking system, and for that the ECB performs assessments, and clearly what those assessments, and we at the central bank, we also do the same, and what the assessments to check how the banking sector is prepared to deal with the situation is that in the central scenario, clearly there is no immediate problem for the banking system to deal with the situation. And even in the more severe scenario, of course, it's more challenging, but it's not to the point where we can say that it's not manageable. So, and of course, this will have to have its translation if and when it occurs in terms of the rating agencies. If you look at what they have been saying until now, they have indicated some reviews in terms of the outlook, but not in terms of changing the ratings. And it is important to stress that banks are more capable of dealing with some of hypothetical consequences of some decisions. The central bank, the ECB, has provided a lot of cushion, even if some risks materialize in terms of, if we go back to things that occurred in the past of trying to link the risk of the sovereign with the banking system, there has been a clear indication that the bonds, the government bonds, will be used no matter how ratings will evolve. Banks will be allowed to use sovereign bonds to get access to liquidity. Again, in the case of the Portuguese banking system, the fact that it has improved substantially since the last financial crisis until it entered the pandemic, I think it provides us a lot of comfort on how it is prepared to handle the next stage. But it is important that all this pandemic is sorted out and the economy recover, because ultimately that's what is important for a long-term sustainability.
Of course. Thank you, Luís. Neil, I would go over to you in London. Are you listening to us well?
I am, yes, I can hear you very well. Thank you.
Hi. So thank you for joining us. I would say that in terms of being a hot topic in this discussion, you are only second to the funds industry, or you might challenge that with Tanguy. So basically, credit rating agencies have behaved differently than from the previous crisis, or at least perceived as having behaved differently from the previous crisis in terms of reaction to the impacts of the crisis. The crisis itself has very different nature, but still you are very in the center of the discussion, both because the financial sector still has lots of kind of regulatory and legal references to credit ratings, and that might trigger automatic responses in some segments of market, and also, of course, because the levels of debt after the global financial crisis increased substantially and increased a lot in corporate debt, for instance, and in high-yield corporate debt, which even prior to the crisis was already, I would say, calling our attention as to the risks that could arise from these high levels of debt, of low quality or lower, let's say, quality debt. So what I would like to hear you about is to give you, to understand a bit on how do you view this, your role in this financial stability debate, and what risk are you indeed for financial stability and your actions for financial stability, and indeed if you should be considered liable for that or if not.
Thanks, Rui. I mean, and firstly, again, thank you very much for the invitation for me to participate. I deeply regret not being able to join you all in person, which allows for a more effective discussion. But hopefully, I come across clearly on screen. Yes, I think what our role is, and this always comes in terms of market stress when we rating agencies are put forward, at least in terms of what our role should be. And I think that stems a large part still from a level of sort of misunderstanding of what our role is and what our role has historically been. And I think to put that back on record is again we are only providing an opinion on credit risk. We're not addressing other types of risk and market risk, etc. And we're really a ranking tool, as I say, that tries to rank order the rated entities that across the globe that we rate. And it's an important role. I'm not going to try and diverge from that. It's an important role, but it is a narrow role in the financial markets. And I think what we often have discussions around generally with policymakers in the market more broadly is really what our role is and what our role has become. And I think a large part of it in terms of what it has become and where the financial stability discussions center around it really how the ratings are being used. And we've been a strong proponent now for close on 20 years and have been backed now by the Financial Stability Board as well after the financial crisis that there needs to be a continued action to remove the mechanistic regulatory use of ratings. We know there's been steps that have been taken as a first action, but that needs to continue because that sort of mandatory regulatory use leads to some outcomes which aren't really acceptable from a market perspective and is not certainly where we as rating agencies want to be. And certainly there's still work that needs to be done in that space. If we combine that with, I suppose, two other measures, the first is making sure that the information that's available to the market is appropriate and is accurate and is diverse. That allows investors also to be put in a place where they have always been, pre-regulatory use of ratings, where they're able to use the information from source and then take the rating agencies as a benchmark to see, is that something where their opinion was going or not, rather than to use rating agencies as the sole information source in making an investment decision, which is simply not what our ratings are designed to do. And if we combine those two then with the third element, which we recognize our role in the market, and we recognize that investors look to see what our view is and what how we rank order the different entities. It's important for us, and we recognize the importance of making sure that we have our methodologies publicly available, and that when we take a rating action, we disclose the information that's necessary to ensure that investors understand why we've taken a rating action, and to be put in a position that if you spend the time and read the methodology and you read the press releases that come with our watch actions or with our actual rating actions themselves, an investor is able to take a step back and say, okay, does this make sense? Do I agree with this approach or not? And how do I mix that in terms of all the other tools that are available to me in making my investment decision. And I think if you put those three elements together, one, reducing regulatory reliance, two, ensuring there's sufficient information out in the market directly from source, and then three, making sure that the disclosure of rating agencies is appropriate. What you're left with is rating agencies back in the role that we were designed really from the very beginning, how many hundred years ago, which is to add one tool, as I say, into that toolbox of measures that an investor has available to them. And what you do is, in my view at least, you actually have rating agencies taking on a financial stability, or at least contributing to financial stability, rather than financial instability, which is sometimes levied at us because of the misuse in regulatory activities.
So let me just ask you this. So you made your case very clearly, but we do have a kind of a very practical problem at the moment. That is, in the next year, and also as Luís was mentioning, there's lots of negative outlooks to credit ratings, but not those many actions as one would expect. And if we take that also with the prospects of a severe recession this year and a mild recovery next year, so it's likely that we'll have downgrades next year, or severe, or a big number of, historically big number of downgrades in the coming months. So that will indeed, until we work out the problems, if what you're saying was manageable, it will not be manageable in the short term. So in the next year or year and a half, what we're dealing is a tension here between your actions and its impacts, even if undesirable, on the financial sector. So how do you view this as a rating agency? Because it's also your credibility then that's really probably at stake at some point.
Yeah, absolutely, and then I'll maybe address your points on what we see as sort of the future economy is concerned in due course. But from a rating agency perspective, certainly from our side, I mean, we are taking strong efforts to ensure that one, as our methodologies are public, and two, that we are able to disclose, and we are disclosing, information as to why we're taking specific rating actions. And I think the more we speak about it, the more we remind investors in terms of the role and their responsibilities in terms of how to look at the different pieces of action, we will put ourselves in a better position. The one area of concern I think that worries me slightly is that when we speak about these issues, there is some views out there in the market that says, well, perhaps what we should do is we should stop the rating agencies from expressing an opinion in sort of a temporary way or a more permanent way in a downturn. And I think that solution is extremely risky. And I think that, the reason why I say that is what we're dealing with, and one of the very purposes of why rating agencies were set up from the very beginning was in order to try and address that information asymmetry that exists between issuers and investors. Now, in good times, there's a lot of support for the work that rating agencies do. We obviously facilitate access to capital, etc. But when we get to a downturn, suddenly the discourse changes to, well, perhaps, let's say, we should temporarily prevent this opinion from creeping into the markets. And as I said, if you're an investor and you're in the markets, or even if you're an issuer, you're continuing to issue debt. Investors are continuing to buy debt, whether it's through the primary market or the secondary market. And some of the solutions are saying, well, what we should do is we should take away rating agencies' opinion. And then what do? You leave investors with even a more stark choice, because investors are going to continue investing. They're going to then turn to other sources of information, whether that's more volatile, market metrics, or whether it's newspapers, rumor, conjecture, etc., which is going to take us back many years and create a more opaque bond market than what we have currently now. So I think the wrong answer is to say, okay, well, let's take out rating agencies, which are regulated, which deal with and mitigate the conflicts of interest and ensure a level of disclosure. And actually, at a time when rating agencies are needed, which is in this financial crisis, we don't shy away from bad news, but we look towards what they have to say and measure it within this broader toolbox of measures that are available to investors before they make a risk determination.
Okay, I'll come back to you on the outlook going forward. Let me come back to Lisbon. And Luís, Morais, thank you very much also for joining us. So we've heard the regulator we've heard the funds industry, we've heard the central bank and regulator of banking, and well, we've heard the rating agency. So now I would like to hear you with your experience following all these matters on where are we really? What are the risks that you see? Are we more resilient? And how do you see these risks tilting from the banking to the non-banking sector? Could you share with us a bit of views on this?
Thank you, Rui. First of all, I would like to thank the invitation and it's my pleasure to be here today. Also, CMVM is entering into an anniversary date, and I want to congratulate CMVM and its chair. It's really a great pleasure to be here also with the members of the panel, although in this context of a video conference, we feel a little bit like in the twilight zone, but we'll try to compensate with debate and trying to keep interventions short. So I will try, if you allow me, to have a step back, to have a wider perspective in terms of the structural conditions for financial stability to the whole financial sector, and also bearing in mind that, as it has been stated in the remarkable keynote address, access to central bank money is fundamental here as a condition for financial stability. It's really essential. So I would try to give a wider perspective in terms of a worldwide view, and I would try to focus very much on the Eurozone and on the conditions for financial stability on the Eurozone. I may immediately put forward that I'm slightly more pessimistic than some of the interventions that have made here, but I will try to, anyway, to qualify that relative pessimism. Well, first of all, so to try to gain a wider perspective and at the same time avoiding a too optimistic and a too pessimistic view, trying to be realistic, I think that we have kind of a paradox here because we have better conditions than in the great financial crisis at the European Union level. So we have huge progress in terms of building a new infrastructure for financial supervision from scratch almost. And we have significant progress, however incomplete, in terms of the European Banking Union and the European Capital Markets Union. Also, the Eurozone was transformed because, in my view, that was not immediately enshrined formally in the treaties, but we have a new stability function emerging, and which has resulted from the practice of the European Central Bank. So the overall conditions in the Eurozone and the European Union are much better. Well, I would say they have no comparison whatsoever with what happened in the previous great financial crisis. Conversely, at worldwide level, I think that we lack a coordinated reaction, particularly in terms of alignment of fiscal policies. We had seen previously, more than 10 years ago, decisive action from the G20 in terms of alignment of fiscal policies. And nowadays, for a number of reasons, this is not the place to discuss the political international scene, we have no conditions for that kind of coordination at international level. But coming back to the European Union, I think that we have witnessed a complete transformation, a complete redress of the European and monetary union with significant pillars of the banking union and the capital markets union. The big question that we can address in wider detail now and in other areas of the debate is if that progress has been enough to face the current challenges. And I would ask your permission to, very exceptional, this is not a place for quotations or for academic debate, but to make a very small quotation from Daniel Gross, because I think he was a little bit prophetic in 2014 when he stated that what the Eurozone really needs is not a system that offsets all shocks by some small fraction, but a system that protects against shocks that are rare and potentially catastrophic. Well, reality never disappoints us, and the problem is that we have met this test of a rare and potentially catastrophic shock sooner than could be expected, and we'll have to see if the transformation of the Eurozone will meet this test. Going back more directly to your question now about the resilience of the financial system and comparing the current resilience of the financial system with the situation of the great financial crisis, and again trying to be short and fulfilling my promise to try to be short, I think that the short answer is yes, much more resilient, but with some qualifications. I would start from the point of view of the banking sector, because the banking sector is still fundamental in terms of creation of money in the Eurozone, although in relation with the new role of market institutions. So I would consider as a starting point the banking sector, and trying not to overlap with Luís Laginha de Sousa, I would take more of a European perspective, more than a national or Portuguese perspective. And if we consider in Europe the data included in the EBA risk dashboard, which provides a short-term outlook for several risk measures, and by the way, I was considering that we would be lacking this kind of precise data in terms of market institutions, but the keynote address has updated me in stating that we are having considerable progress in having more precise data also in terms of the functioning of capital markets. But if we consider the EBA risk dashboard and also the June 2020 and September 2020 Eurosystem staff projections, these outline potential vulnerabilities of the banking sector, with a particular emphasis, on the one hand, on asset quality and credit risk, and on the other hand, on potential liquidity risks. And on the contrary, ahead of the COVID crisis, capital ratios and the asset quality of banks in the European Union had improved significantly, although the return on equity had further worsened somehow. So I would say that we have a mixed situation here, which is bound to affect other parts of the financial system, and again acknowledging the great progress in terms of a new role, of a new enhanced role of other market players in the capital markets. We also have to acknowledge somehow the insufficient development of capital markets now in Europe, which is something to be corrected in the near future, but is not feasible in the short term. And we have to consider that banks have still a pivotal role, also considering that banks cut across the entire economy, and they can create money instantly by allowing overdrafts and opening credit facilities. So I think we have a very mixed situation now, and naturally the materialization of these risks, which Luís Laginha de Sousa has also addressed, and any build-up of other financial pressures on banks or other parts of the financial sector will depend very much on the duration and on the intensity of the shock in the real economy. And I think, unfortunately, it is still too soon to perceive in the context of the second wave how things will evolve.
So let me just ask you on that quote from Daniel Gross. Hearing what you quote, the quote could probably assume that we indeed faced a severe crisis and, well, let's see the duration, but a severe shock at least, and managed to cope with it pretty well. So the banking sector was resilient. The non-banking financial sector was, there were challenges, but I think it's fair enough to say that it was also resilient. So how happy should we be with this result? So are there policy actions that should be taken, areas where you think that we should be looking more carefully in the coming policy decisions and choices in the coming?
Well, certainly. I will divide my answer between a structural dimension and a short-term dimension. In terms of a structural dimension, I think that we may address that at a later stage of the debate, and I would like to focus on the remaining progress that we will have to consider in terms of the banking union, and above all, in terms of the capital markets union, which needs to be, I would say, reinvented and entirely redesigned. In the short term, I think that the big challenge is how, in terms of exceptional regulatory measures, again I'm thinking above all in the banking sector, but considering the spillover effect that the banking sector has for the other parts of the financial sector, how can we somehow consider the phasing out of the exceptional measures which have been adopted? And I recall that 2 or 3 days ago, André Andrea from the SSM has already stated that they are pondering some type of phasing out of some exceptional measures. So how are we going to cope with this challenging of withdrawing some of the exceptional measures, and how are we going to calibrate this adaptation and phasing out of the exceptional measures in the transition from the current year to next year? That being said, I think that we have to acknowledge that the reaction from the part of European regulators and supervisors has been truly exceptional. I think it's unimaginable to have this kind of reaction, the adoption of the whole gamut of exceptional measures that we have seen between March, April, and May 10 years ago. So I think that, again, we have reasons to be somehow optimists, but I would like to try to be realistic and keep some prudence here.
Thank you, Luís. So the discussion is very interesting, and we've moved quite a lot on time. So I'll probably go to the audience and ask if anyone would like to ask any questions to our guests. So here in the front, please. I would ask you to introduce yourself, and if anyone has questions, I'll put them together, and then I'll try to distribute them to our guests.
Good afternoon. My name is Cristina Sofia Dias. I would like to pick up on what Luís just said, because I think from the panel, and even if Luís was saying that he didn't want to look very rosy, in fact, apparently things are going well on financial stability. Does it mean that we should start looking for an exit strategy from all of that? Or the challenges that we still have are rough enough to keep this stabilization effects that have been put forward by all the relevant stakeholders a little bit longer? Thank you.
Thank you, Cristina. Any other questions? No, so I'll just borrow your question and use it in our discussion, and I would go to Brussels again, Tanguy. So 2 points here. One is, how confident are you that we are out of the woods, and then would we be ready to kind of adopt exit strategies? This is the question from Christine, and probably all of you, since this is probably our last round, could probably answer this question. I would also like to ask you, so Robert Ophèle in his intervention really put here kind of a regulatory policy agenda for the non-banking financial sector. And I would like to hear you on this. So you're not fond of liquidity buffers. You think that liquidity management tools work well, or at least efficiently, or at least as needed until now. You also think that probably access to central bank money should be made more available. That's also something that Robert Ophèle has put forward, and that Professor Luís Morais has just said that is fundamental. So a brief synthetic overview of what you think are the main policy answers that we should be taking in what comes to regulatory actions in the coming months.
Yes, thank you, Rui. When it comes to the first question, are we out of the woods? Frankly, I don't know. What I know is that asset managers are, rich of the experience that occurred in March 2020. So, this is kind of building up experience. No doubt that, in the upcoming stress testings, asset managers will take into account the data from March and April, and this will just, strengthen the entire framework. If I look at concerning the central bank money, what I meant is that we need to better understand what has been the impact on the liquidity in the markets, because clearly I think the fund sector did well, but of course we need to acknowledge that a part of it is due to market participants having the confidence because of the ECB or Bank of England interventions or the Fed in the US. So in terms of kind of policy responses, I think what is absolutely key is that those policy responses be data-driven and fact-based. And also it's important to take a kind of holistic view of the entire ecosystem. It's not only banks and asset managers. Actually, you know, if you look at the fixed income space, funds only hold a small part or portion of the entire fixed income universe. You know, the majority of the bonds are held by the asset owners, like, you know, institutional investors directly, like pension funds or insurance companies. So basically, if you were to basically try and control the activities of the asset managers, because you have concerns about the liquidity in the bond market, just remember that, you know, we are just talking about a small portion of the entire market. So that's also important. And also what is important is not only to look at what did not work, but also to look at what did work. And a lot of things did work in March. You know, again, I want to go back to this use of liquidity management tools. I think that this is absolutely key. It's very important. You know, maybe the new normal will be a world with more volatility, more financial instability, and more use of all the liquidity management tools, including, you know, gating, for example, or advance notice periods being imposed if you want to get out. So maybe this is the start of a new paradigm, but we simply don't know. So I think our message is, you know, to say there should be a focus on supervision and enforcement of the existing framework more than anything else. And believe me, the asset managers are not staying inactive. You know, they are in almost daily contact with the NCAs, with the market authorities. The market authorities are asking questions. As we know, ESMA and the NCAs are conducting, as we speak, a supervisory action on the way funds manage their liquidity. And all this work is in progress. We also have these IOSCO recommendations on liquidity and on leverage. And IOSCO is assessing, you know, how those recommendations on liquidity have been implemented at national level. And they will do so also for the leverage recommendations as of 2021. So I think there is a lot out there, and we just need to make sure that it is properly enforced. And we need to make sure, and there I fully agree with Robert Ophèle, we need to make sure that IMF, but also the other NCAs, ESMA, the ESRB, the ECB, that they have the data that they need to do a proper job and to make sure that you know, we keep the financial stability which is required. And there, frankly, I think that the point that he made, and I will just stop there, but I think it's important to quote him. He said, you know, we need more data at EU level. It should be harmonized and consolidated. Well, I think this is the point I made this morning in my intervention. You know, we report a lot of data to NCAs at national level, but also to the central bank. I think there would be merits in considering how, you know, all the data which is available out there can be maybe consolidated indeed and harmonized to the benefit of all the supervisors.
Thank you, Tanguy. Very, very clear your position. I think we have one further question here in the front, and I cannot say no to this one. May we have a... just here in the front, thank you. So Tanguy, am I fair to assume while the micro comes to Gabriela, she will like to make a question or a comment, just to make sure. So from your point of view, one of the risks that we're facing here is that we react too quickly on regulation to the crisis instead of using the existing tools that we have to do supervision. Is that clear?
Yes, because, you know, it's not as if the NCAs and ESMA is doing nothing. We have this supervisory action, this common supervisory action undertaken by ESMA, And so, they are working day in, day out on those liquidity issues. They've asked the fund, the funds to report data, and this is work in progress. So I think that, I'm not saying that nothing needs to be done. I'm just saying that everything is being done. But certainly, before considering introducing new macro, not micro, macro-prudential tools, we should first make sure that everything is done at micro level between the NCAs and the funds under the coordination of ESMA. And ESMA, frankly, has a number of tools to make sure that there is more convergence in the use of those tools.
Thank you, Tanguy. Gabriela, would you like to make a comment or a question?
Thank you. So here's Gabriela. I don't know if you can see me, and I don't know how it works, but I'd like to take the opportunity to thank you all for this excellent panel, and special to Neil and Tanguy, who are attending from the distance. And I have two short and very simple questions, one for Neil and one for Tanguy. For Neil, my question is, considering the many times mentioned here, decoupling between the real economy and the market behavior, what is, from your perspective, your main concern about the near future? I mean, in your perspective, what may happen with regard to this decoupling and the next developments with regard to that? And my question to Tanguy is based on what we heard here from you, based on what we are doing as market regulators with regard to liquidity management tools, valuation, leverage, and these things, but considering above all that we are, and we all know that we are under the pressure of macroprudential regulators, what is the future of the investment management sector supervision from your perspective, seen from your side? Thank you.
Thank you, Gabriela. So, Tanguy, I would invite you to answer first, and then Neil, I would go to you. Tanguy, would you like to comment on this?
Yes, I mean, that's a tough question, Gabriela, but thank you for raising it. As I guess, the audience will have understood, I think that, we very much favor, micro supervision. We need to make it work. We praise the work of IOSCO, ESMA, and the members of ESMA in that space. I think they are much closer to the fund industry than central bankers, for the most part. As I mentioned, we are very concerned about ill-suited bank-like regulations applying to our sector going forward. We do believe that we passed the March 2020 test successfully, and this is why I was making the point that it needs to be fact-based. I was very interested in the comment made by Robert Ophèle. If I understood properly what he said, he promoted this idea of a lead supervisor, which should be designated in the country of the asset manager. So, I will see whether his intervention is somewhere to be found on the IMF website. But this is a very interesting proposition, one which I believe would, get some resistance in our membership. I think that, the whole asset management industry is built around this idea of domicile and passport. We have fantastic ecosystems in the EU27, and those are used, those EU domiciles are used for distributing our products across the EU and internationally. And we are a bit concerned, frankly, about, those repeated calls for more centralized supervision of asset management companies. The Commission, in the context of the high-level forum on CMU, there was an attempt, to go down that road. At the end, I think there was some pushback. It was not included in their final recommendations, but I have no doubt that this will come again. And I think that we are certainly not in favor of any further centralized supervision when it comes to direct supervision of large asset managers. We believe that the current system works fine, but we, at the same time, very much support any efforts made by ESMA and its members for far more convergence of supervisory practices. Robert Ophèle mentioned, using more regulations than directives. I remember Lamfalussy was asking for that already 20 years ago. And so I think it's nothing new, but it's something we can fully support. But, you know, really supervisory convergence and having a robust rule book and proper enforcement of the rule book is, I think, a good starting point.
Thank you. Thank you very much for your answer. I'm sorry to interrupt you. I'll have to ask our guests to please be short in the final round, as we have reached our limit. We started with a few minutes delay, so we'll still use that time. So Neil, I would go to you in London, and well, we have at least 2 or 3 questions here. One is, are we out of the woods? The other one is decoupling and the impact that might have on your actions. So how would you comment on those both on both those issues?
Yeah. I mean, thanks, Gabriella. Thanks for the question, and Christina as well. And hope you're both well. I mean, I think I'll try and sort of answer it technical and short as I can. I mean, I think I want to collapse in another question as well, or another sort of I suppose expectation that there's going to be this slew of rating downgrades next year, which I don't think is the case. I mean, certainly we're expecting that rating actions to moderate over the second half of this year. We went through a significant exercise, and Rui, you mentioned this first. You saw a change in terms of how Moody's in particular addressed the COVID crisis, and we did that through a very systematic way of looking at our rated entities and really focusing and drawing our attention to those sectors at most risk, retail sector, airlines, hotels, etc. So that's why you saw that change. Now, the problem that we have, and as everybody's been alluding to, and from what I can gather this morning as well, is this level of corporate indebtedness that's there, and that's only got more and more sort of relevant as during the crisis a lot of companies have used, whether it's the reduced interest rates or whether it's the the government interventions ready to increase their liquidity positions, such that they'll be in a great position at the end of this year. Now, what they're using that liquidity for, we'll ultimately have to see. But we do ultimately maintain a negative bias on our ratings outlook across most of the sectors, and it is most pronounced in the global corporate sector. I think we've got around 35% of our non-financial corporates with the negative bias, which means they've either got a negative outlook or on review for downgrade. But we do think that the investment grade companies in particular have a strong resistance and flexibility to be able to deal with what comes. And so whether there's a decoupling, and we know that corporates are probably going to need more access to equity, which is not something that the banks are well positioned to assist with. It's all very sort of unclear at this point in time, but we think with the flexibility on the part of the sort of the large corporates, we think that they've got enough tools in their belt to try and succumb some of the more immediate short-term issues that will be faced from an investment grade perspective. I think more broadly, something that we're watching out for, and to Christina's question, is on fiscal policy fatigue is one of our areas that we're looking out for. We obviously, as Luís mentioned, there's been this fantastic sort of policy intervention. Our question, and very much in our minds, is how long that will go on for. And one of the risks that we see as far as a downside risk is concerned, or which might interfere with our view of rating actions likely to moderate, is very much a step change in that governmental fiscal support. If that changes significantly, or if there's a financial crisis again, or if there's a second wave, that's going to change. So I think at this point in time, from our position, if there was a rapid withdrawal or a sort of fundamental repositioning of fiscal measures, that would be something that would be concerning to us, at least from a ratings perspective.
Thank you, Neil. Thank you very much also for your effort to share with us a lot of information in very little time. Thanks. Professor Luís Morais, so could you just mentioned in your previous intervention that you'd like to address the issues of a more structural dimension to deal with financial stability. I was wondering if you'd like to address that in the context of what policies do you see that would be desirable in the coming months or years?
I'll try to do it and keeping it short.
Yeah.
If you allow me, I would just make a previous point, because I've refrained from intervening in the discussion about ratings and possible downgrades, since there are people more specialized than I am discussing the issue. But I think it is really a very sensitive issue, and I would like 2 very brief points. First of all, I think that ESMA gave a very important signal some months ago when the chair of ESMA stated that they would be having an interaction with rating agencies to perceive the way rating agencies would assess the impact of the crisis in rated entities. So that was a very important signal from the part of ESMA. And being a little more provocative here, but that's the prerogative of academics, I would say that things may be possibly changing in terms of the relevance of ratings. I'm thinking here about some change of policy, for instance, of the ECB in terms of the types of bonds and assets that they accept as collateral, and a more open-minded policy in terms of the types of debt, even some types of junk bonds that are accepted as collateral, will have a significant impact on the relevance of ratings. So this is possibly a game changer in terms of the overall relevance of rating. Well, in my final 2 minutes and being very, very, very brief, my structural points had to do with completing the construction of the banking union and the capital markets union. And we have starting points which are completely different in one case and in the other. I think that in terms of the banking union, we have fundamentally two challenges. One is to build some form of gradual mutualization of the guarantee of deposits. It has to be a gradual process, but we have to find criteria which are feasible to build some kind of mechanism to ensure a type of European deposit insurance. It will be still a rocky process, a difficult process. Secondly, I think that we have to reinforce the single rule book in terms of banking regulation, which was also a concern that was mentioned on the keynote address as regards the single rule book for the regulation of capital markets. So I think these are two pressing issues. On the capital markets, I think that the initial attempt to build a capital markets union was largely a failed attempt. I've used somehow provocatively in a book the expression that the first attempt to create a capital market union reminded me of a play by Pirandello, 6 characters in search of an actor. You don't know exactly what is the unifying idea, the unifying institution. And I think that we can see now some initiatives which are very relevant, the creation of a high group to reflect on new projects in terms of capital markets union. I would say that in terms of structural challenges, the biggest challenge now would be to find a roadmap to a new reinvented capital markets union. I think that the details, we don't have the time to discuss, but I merely flag this idea.
Thank you very much. So, Luís, the closing intervention. Yeah, maybe you could address also this idea of are we out of the woods or not, and how do you see the risks going forward?
Yeah, probably I'll link that to when I heard Christina's question, and since she was mentioning Luís and looking at me, I assumed it was. I feel compelled to provide a little bit of an answer and to combine that as well. So I think no one believes that this level of support is sustainable forever, so there will have to be a stop. But I would like to think of a word that is very important, which is the word flexibility. Flexibility is key for resilience, not just in physical structures, and I think it's important to use this analogy because, you know, bridges, buildings, they have to be flexible in order to be better prepared to handle big shocks and big impacts. And I think the same reasoning applies also to both financial and non-financial corporations. But we should not interpret flexibility as the equivalent to being less demanding. And this means that we'll have to clearly separate and keep this very clear in our minds, to separate what is viable from what is not viable, so that we channel the flexibility and the support to those that are essentially facing liquidity, temporary shocks, and not for those who are not sustainable, viable over the long run. So this means that this flexibility can translate into, keeping support for as long, but also for as necessary and possible it can be kept. And I would say that if you think in the longer term, there has to be something that needs to be addressed if we want to make a substantial change from what has been done so far. I felt this in my previous life, that whenever there is a problem, we always talk about financing, about debt, more debt on top of that, debt. And there has to be a moment where we really address the other component that needs to be there and needs to be much more present, which is capital, equity. So this has to be addressed and has to be thought about right now, so that we are very prepared for the future.
Luís, thank you very much also for your intervention and these last words that are very close to our hearts and the discussion that we are having here today. And well, I'll thank you, all the four of you. This was a very enriching discussion and a very good contribution to to the construction of a more, we'll hope, a more resilient economy. I would like to thank all the audience here or via Zoom, and I invite you to a round of applause to our guests here. Thank you, Tanguy. Thank you, Neil. Thank you, Luís.
Thank you very much for this interesting debate. Vamos agora proceder à entrega do Prémio José Luís Sapateiro, que na sua edição de 2019 contou com 2 vencedores ex aequo. Walter Gouveia, autor do estudo O alcance extraterritorial das normas de governo de produto, e Diogo Marques Cardoso, autor do estudo Das ações preferenciais sem direito de voto, os aspectos críticos de um regime imperativo rígido. Convido a subir ao palco Walter Gouveia para receber o prémio. Diogo Marques Cardoso não poderá estar presente, mas o prémio ser-lhe-á entregue em momento oportuno. Convido também Gabriela Figueiredo Dias, presidente da CMVM, a subir ao púlpito para proceder à entrega do prémio.
Antes de mais, 2 palavras de parabéns para o Walter Gouveia e para o Diogo Cardoso, que não pôde estar presente. Uma palavra para o tema do trabalho do Walter e o tema do trabalho do Diogo, que são da maior relevância para os trabalhos que estamos a conduzir, como hoje já foi possível aqui constatar. O tema do governo do produto é um tema crítico para a proteção do investidor, e a extraterritorialidade num contexto de internacionalização e de distribuição além fronteiras é fundamental, e, portanto, parabéns e muito obrigada pelo contributo que nos deixa. No que respeita ao trabalho do Diogo Cardoso, que não pode estar presente, relativo às ações preferenciais sem voto, já hoje foi aqui também mencionado que é uma das preocupações que iremos, trabalhar na sequência das recomendações da OCDE, no que respeita à reserva dos acionistas controladores de partilharem esse controle e, portanto, de ser necessário disponibilizar instrumentos societários que permitam lidar com este tipo de situações. Portanto, como se vê, 2 temas importantíssimos, 2 temas interessantíssimos. Uma palavra ainda para sublinhar a importância da investigação académica e científica para a CMVM. Somos um supervisor bastante operacional, com muito interesse neste tipo de investigações, mas para a qual contamos sobretudo com a universidade, com os universitários e com todos aqueles que, com a capacidade para o fazerem, contribuem com conhecimento, que é algo que nunca é demais e do qual necessitamos para fazer as coisas com correção, focadas naquilo que é importante e da forma adequada. E, portanto, muito obrigada. Deixem-me também agradecer ainda ao júri destes trabalhos, e em particular ao professor Alexandre Sobral Martins, que vai de propósito a Lisboa e a esta conferência para estar presente, enfim, a participar na conferência, mas também a celebrar este momento de parabéns ao Walter e ao Diogo. Muito obrigada a todos e muito obrigada a ambos. E muitos parabéns.
Fazemos agora uma pausa para café. Como estamos com 5 minutos de atraso, voltamos a encontrar-nos aqui às 16h20, por favor. Obrigada.